Hello everyone, welcome to Chapter 6, lecture on self-employment. So in this chapter we're diving into Schedule C and it's going to include a big focus on depreciation, which is when you buy assets that are things that you use in your business to make money. Things like real estate, things that you're going to use for many years, more than a year, and they're going to be giving you value, and so that's why you don't deduct the full cost up front, although most small business owners do get to do so, and mid-size now. But the point is that you would allocate that cost over time, and the IRS has very strict depreciation rules, but then there's bonus depreciation that allows people to deduct more up front. So we'll be getting into all of that. It's a good half of this chapter is going to be on depreciation, but the problems aren't too hard and I've created videos for you, so that should help. All right, so our first learning objective is income and expenses of the self-employed. So self-employed is for anyone that has a trade or a business. And when you think trade, it's like someone working in an industry who's working for themselves. Essentially, if you're working and employment taxes aren't being withheld from your paycheck, you're self-employed. You might be called an independent contractor. They might ask you to fill out a W-9 and then give you a 1099 at the end of the year, which I'm sure you've probably heard of, and that's self-employed. You can make a single member LLC, self-employed. Any activity that's engaged in for profit. You don't have a business unless you are seeking profit. You can have losses, but you can't form a business for the purpose of having losses. That comes down to intent and can be hard to gauge, right? So self-employed income is reported on Schedule C, which is attached to the individual Form 1040. And it includes gross receipts. So what they're saying, gross receipts, all of the income that you report on that form includes any sales to customers, work performed as an independent contractor, and amounts reported to a statutory employee. Now this is a very rare situation that was created just for insurance salesmen. As if insurance salesmen needed their own way of being, of working and being taxed. So if you think about it, when a person works, they're either an employee and they have taxes withheld by the business, they're required to do that, or they're self-employed. Well, there's this one other type for insurance salespeople only, which is a statutory employee. They have the benefits of a W-2, and they have a W-2, and they're also able to deduct their expenses on Schedule C. This is unheard of. And I don't normally tell people about this because people will get confused and think that they can somehow do this, and they can't. It's just this very peculiar situation. But someone could have all of these things happening, right? They could be working for themselves. They could work as an independent contractor for one business, and they might be a statutory employee for an insurance sales for another business, which actually is kind of common. Anyways, at the end of the year, if they're paid more than $600, the business that paid them must file them a 1099 miscellaneous, reporting the amount they paid them. Now, this has nothing to do with the self-employed person. The self-employed person needs to report all of their income regardless of any 1099 that they get or not get. So a contractor doesn't need to worry about the business issuing them a 1099. But if the business does, then they want to be sure to report it. Cost of goods sold. So we have all of our sales. If you sell products, we have cost of goods sold. Goods are the products. So you buy products and then you sell them. And then that gives us gross profit because we're only subtracting the direct costs of those sales And then we subtract our operating expenses, and then that gets us to net income, which might sound familiar from accounting. Now, when you have inventory, the general rule is that accrual method of accounting must be used. Now, if you've taken your accounting classes, you know the difference between accrual and cash method is that accrual method allows you to really understand how profitable a business is. Large companies are required to use accrual method, and it makes sense for inventory businesses to use accrual method. Now, so the general rule is that they're required to if inventory is a material income producing factor, which means the main way that the business operates is selling products. However, then we have an exception if average annual gross receipts, so you add up gross sales for the last 3 years, is under 25 million, then they can use the cash basis. But I'll be honest, if someone has average annual gross receipts, so that means 75 mil, they could be up to 75 million for 3 years, you want to use accrual. You don't want to use cash method. Remember, with cash method, we record income when received, expenses when paid. Accrual method is we record income as sales, as revenue, when it's earned, and expenses when incurred, when we get the bill, versus allowing the movement of cash, which we can control and manipulate, to determine our net income. All right, concept checked. So Schedule C is used only when an individual is an employee of a company. Do we use Schedule C when you're an employee of a company? No. Income reported on Schedule C will always match the amount of the individual receives on one or more 1099 miscellaneous. Could the self-employed person have other income than the 1099 or even more than one 1099? Most likely. So no, it's not going to match. If inventory is a material income producing factor, the main way the business makes money, then the accrual, or at least a substantial way, the accrual method of accounting must be used to account for inventory. That's true, but then we have that exception. If average gross receipts over 3 years is under 25 million, which means you add up sales each year and then divide by 3. And as long as that's under, for the 3 years, as long as it's under 25 million. And there are more exceptions now as well. Okay, so now we're talking about trade and business expenses. And the key words here are ordinary and necessary. So to be deductible, expenses must be ordinary, necessary, and reasonable. Ordinary means that the expenses are customary, they're usual. Necessary means that they're appropriate and helpful, not necessarily essential, meaning they don't have to need these things. It could be a choice. Reasonable expenses must be reasonable in amount, reasonable in relation to their purpose. Generally, when I work with small businesses, anything they're spending because of their business qualifies to be written off. What doesn't qualify is anything that's personal that they're trying to write off under the business. If they're spending the money and they wouldn't spend the money if they're not in business, it's deductible. Forbidden expenses. You cannot deduct bribes, kickbacks, or legal payments. Can't be deducted. You have to still report illegal income, but you can't deduct illegal payments. Lobbying, political expenses, although I feel like it happens a lot, fines and penalties. So if you have a tax late fee, that's not deductible, but your state taxes would be, but a state fine would not be. Not deductible, even if ordinary, necessary, and reasonable, of course. So for an expense to be deductible in Schedule C, the expense must be, what was it? Ordinary, necessary, and reasonable. Certain types of expenditures are expressly forbidden from being deductible from income on Schedule C. What are 2 examples of forbidden expenses? fines and penalties, political, lobbying, bribes. Now, depreciation. Okay, guys, this is what I was talking about at the start. When you buy something to use it in your business to make money, that's called an asset. So it really comes down to why you're buying this thing. An asset for one company might be inventory for another. A car dealership has cars which are inventory because they're selling the cars. A car for most other businesses, or truck or van, is going to be an asset. These assets are capitalized, which means the value goes on the balance sheet. Assets equals liabilities plus owner's equity. And then you take depreciation expense according to the rules. So these rules, the things we've got to determine to calculate the amount of depreciation expense that you can take the first year, begins with the cost of the asset. Now, if you buy some equipment and you get it sent to where you work, it also includes all costs of getting the asset ready for its intended use. So if you had that piece of equipment shipped and then had installers install it at your business location, all of those costs are not just going to be deductible. We're going to sum them up in our basis for depreciation. Then we've got to look at what is the asset class lives. And when we do some problems for this chapter, we'll be looking at them. There's 5-year property, 7-year property, 15-year property. Residential real estate is 27.5-year property. Commercial real estate is 39-year property. That's called the class life. Now, depreciation convention. This has to do with the first year that you purchase the asset. You know, if you purchase an asset on December 31st, the last day of the year, what would be reasonable? You would get 1 day out of 365 of depreciation. But no, we don't do it that way. Instead, the standard rule for most assets is half-year convention. So in the year you buy the asset, whether it's January 1st, the first day of the year, or it's December 31st, the last day of the year, you take half a year of depreciation. Unless you put more than 40% of your assets into service, which is when you started using them in the business, during the last 4 months of the year, or 3 months of the year, the last quarter. In that situation, we're going to switch from half-year to mid-quarter convention. Half-year convention, mid-quarter convention, and you'll only get a quarter because we don't want people buying all their assets near the end of the year and getting a big deduction. So it changes from them getting half a year to only a quarter. Now, mid-month convention just means that in the month of purchase, you get half a month. Whether it's the first day of the month or the last day of the month, you get half a month for purchase, half a month in the month that you sell or dispose of the asset. So if you get 1 quarter, in the last example, if you get 1 quarter in the year you purchase, you're going to get 3 quarters in the year that you dispose of it. Now, with mid-month is only for residential property. Or, I'm sorry, any real estate, residential or commercial. Half year and mid-quarter apply to everything else. 5-year, 7-year property, those are the most common. Equipment, furniture, those types of things. Now, our depreciation method, how we actually calculate. So usually in basic books, we use straight line, which is just going to be the cost basis, divided by the asset class life. $10,000 basis divided by 5-year asset is $2,000 per year. That's straight line. However, tax method is going to be more of a 200% declining balance, which is switches to straight line once it but it allows you to take a bigger deduction up front, and it's easier to show you this in theory. But what it is it's double whatever straight line would have been. So in that last example, straight line was $2,000. Your first year, $10,000 cost basis. First year depreciation under 200% declining balance would be $4,000. Now, this depreciation expense for the year is reported on Schedule C or Schedule E and Form 2106. Now, it depends. Report on Schedule C or E. Schedule E is if you have real estate or if you have income from a pass-through entity. Schedule C is if you're self-employed. Many forms, all of the business forms can report depreciation. So our basis is asset purchased. Basis is cost. Now, if you have an asset that is personal, real estate is common, and you change it to business, so let's say you start using a residential property as a rental property, the basis is not your cost. It's the lesser of the fair market value on the day that you put it into a business, began using it for business, or your cost. The lesser of, which it's typically, there's a lot of different situations there. It can be rather harmful. Non-taxable exchange. So if you exchange for a like property, which we'll talk more about those later on, then your basis is typically your own basis, adjusting for any deferred gain or loss. When you inherit an asset, basis is the fair market value at the date of death. So you can see that there's different, you have to consider how you got the asset. Certainly purchase is most common, but there are other ways, other calculations based on how you acquired the asset, whether it was purchased, whether it was personal and then used for business, whether you did an exchange or you inherited it. So Shelley purchased a laptop computer for her personal use last year, $2,200. This year she started her own business and transferred the computer to the business. The value of the computer at transfer was $1,300. What is Shelley's depreciable basis in her computer? So if she had bought it and started using it for business, $2,200, but she didn't, it's the lesser of fair market value when it was transferred for business or cost. So it's going to be $1,300. Jackson purchased a van for $22,000 and he used it 100% for business. In the current year, he deducted $4,400 in depreciation related to the van. What is Jackson's adjusted depreciation, adjusted basis in the van at the end of the year? So he purchased for $22,000. He used it completely for business from the moment he purchased. In the current year, he deducted $4,400 in depreciation. So what is his adjusted basis? We didn't cover this. Cost basis minus depreciation taken equals adjusted basis. So $22,000, this question had nothing to do with what we just covered for calculating. $22,000 minus $4,400 is going to equal $17,600. There we go. So objective 3, depreciation. So typical depreciation periods. This is what we were talking about, class life. 3-year property, specialized tools, racehorses. 5-year property, autos, trucks, computers. 7-year property, furniture, fixtures, equipment. 27.5 years, residential, real property, houses. 39 years, non-residential property, commercial property. Okay, so an auto used in a trade or business would be depreciated over what period of time for maker's tax purposes? Well, where do we have vehicles? 5 years? Oh, an auto used in a trade or business. Now, the one thing I'm going to tell you, vehicles have all sorts of special rules. So they're saying 3 years, although it looks like it's 5 years here. We'll have to see about that and the problems. Okay, an auto use in a trade or business would be depreciated over what period of time for maker's tax purposes? Okay, they're giving us these as options. Answer is 5 years. An apartment complex would be depreciated over what period of time under maker's tax purposes? What is an apartment complex? That's residential, right? Residential is 27.5. Commercial is 39. So the person, it's residential use, so it's got to be C, 27.5. It's based on how it's used. A warehouse would be depreciated over what period of time for maker's tax purposes? 10 years, 20 years, 27.5, 39. What is a warehouse? Is that residential? Real estate? No. So it's D. It's commercial property, which is 39 years. Now, our depreciation conventions. Half-year convention, which is the standard for all property, all types of assets other than real estate. If you put all of your assets, or more than 40% of your assets, into the business in the last quarter, then you switch to mid-quarter convention. Now, this means that you get a half year in the year that you started using the asset for business, and in the year you stopped using it for business or sold it or disposed of it, you get a half a year. When you use mid-quarter, in the year that you started using the asset for business, you get half a quarter of depreciation. In the year you stop using it for business, you get half a quarter of depreciation. No fancy rules for real estate, whether commercial or residential. Mid-month applies. In the month you purchase the real estate, you get half a month, and then depreciation is going to start. So let's say you bought real estate in September. You're going to get half a month for September. You're going to get October, November, December, 4 months or 3 months. So you're going to get 3.5 months in that first year. And then whenever you dispose of it, you're going to get each month up until the month you disposed, and then a half month in the year of disposal. Convention is the same in the year of disposal. A taxpayer can choose any depreciation convention as long as he or she is consistent in doing so. I just explained how the conventions apply, so that's false. A taxpayer must use mid-quarter convention for personal property if more than 40% of the property is purchased in the fourth quarter. Well, good thing I explained that, right? Because they didn't in this PowerPoint. True. The half-year convention is most often used convention for personal property. Yeah, right, because I said it applies for all of the useful lives most of the time. It's only when you have a bunch of assets being purchased at the end of the year. To depreciate an apartment complex, a taxpayer should use half-year convention. Mid-month applies to real estate. An apartment complex is residential real estate. It's used for people living in it. Taxpayer must use the same depreciation convention in the year of disposal as the convention used in the year of acquisition. True. All right, so now we have our methods. 200% declining balance. Remember I said it switches to straight line when straight line would be more. 150% declining balance switching to straight line, and then straight line. Shu purchased a piece of, so now we're going to talk about how you actually calculate depreciation. Essentially, you just use tables that once you factor all of those depreciation factors in, you have all that information, you look at a table. Okay, Shu purchased a piece of business equipment for $12,000 on May 3rd, 2018. This equipment is the only business asset purchase. She was purchased during the year. Her only purchase during the year. What is the depreciation expense related to the equipment? So, first thing we need to know, basis. What's the basis? $12,000. Second thing, what type of equipment is it? It's equipment, 5-year or 7-year property, 7-year I think. We would just look at that table in your book. And then on May 3rd, so we have to do that test for the convention, right? The standard is, this is not real estate, so it's not mid-month convention, it's half-year convention. But we first need to verify that more than 40% of the assets placed in service were not placed in service during the last quarter. October, November, December is the last quarter. Nothing placed in service then, all before then, so she's fine. But this was her only business asset. So if this was placed in service in, say, October or November, then what? Well, 100% of her assets, one, would have been placed in service during the last quarter, and we would have had to use mid-quarter convention instead of half-year convention. Otherwise, if it's real estate, residential, or commercial, mid-month. So now that we have all of that information, and we know that equipment typically uses 200% double declining balance. So we're going to come over to a table, and you can see this says recovery year. This is 3-year property, 5-year property, 7-year property. I believe it's 7-year property. We're going to say the first year, half-year convention. So we take this amount, 14.29%, or if it was 5-year property, it'd be 20%, times 12,000. Let's see what the answer is. $1,715, which 20% would have been so it's going to be this 14.29. That looks about right. And then if she sold the equipment on January 5th, 2020, what would the amount be? So what are we asking? We're asking what is the depreciation in 2020? So if we purchased in 2018, that's year 1. 2019 would be year 2. 2020 would be year 3. What convention applies? The half-year convention. So we're going to look at the same table. We're going to go down to year 3 because this is the year we're in. And we're going to come over to 7-year property. And we're going to take this amount for the half year, 17.49 divided by 2. Because we're only going to get a half year. And in this year, it would have been, this would be for a full year amount. This is the half year on the way out. It's 7-year property. See how there's 8 years because the first year is a half and the last year is a half. So it's going to be this 17.49 0.1749 times 12,000 equals 2,098.80 divided by 2. 1,049.40. So 1,049. Last one, Davis purchased an apartment complex on March 5th, 2018 for $330,000. What is Davis's depreciation expense related to the complex? So we're going to assume that's the only asset since we weren't told anything else. But this is real estate. So it's mid-month. We're going to get half a month for March, full month of April, May, June, July, August, September, October, November, December. So it's going to be 9.5 months of depreciation. And we need to go to, is this real estate or commercial? Apartment complex. So it's residential, 27.5 years. We can see that here, 27.5 year mid-month convention, straight line. I haven't mentioned this yet, but double declining balance only applies to the lower class lives, not real estate. Real estate is straight line. So we're looking recovery year in this column and the month in the first recovery year the property is placed in service. So we were in March, right? So that's a third month. So we're going to go year one. Let's zoom in. Year one here. And then we're going to come over January, February, March. And they've already calculated this as a percentage. So we're going to go 0.02879 times 330,000, 9,501 if I round it up. All right, so IRC Section 179 expense. So remember I said you have to allocate the cost of the asset over time, but most small businesses actually get to deduct it all, even moderate size. Well, that's this Section 179. So in 2017, you could deduct the first $510,000 of assets up front. In 2018, and this is pretty unheard of, they doubled it. It really hasn't been this high, 1 million. However, Section 179 cannot create an NOL, which would have made it advantageous to people who, figure out a way to buy a lot of assets. But what this does is it says, no, you got to be the type of person that has income to offset this with. So this really took it away from being a smaller type of business thing with this $1 million expense deduction. All right, assume the same asset purchase as concept 6-6. Shu purchased a piece of business equipment for $12,000 on May 3rd. Only business asset purchased. Business has substantial income. What is Shu's deduction for equipment, assuming Section 179 is elected? Would there be any additional maker's regular depreciation? Well, you get to choose, but no, she would deduct the full $12,000. Section 179 would be $12,000. Additional makers would be $0 because she could take up to $1 million in cost basis deduction as long as she has income to cover it. That's what this substantial income is. She's got to be able to subtract this as Section 179 expense and not be negative. What if the equipment Shu purchased, and what's interesting is you can have a negative business loss, you just can't have a negative net overall, so you have to have other income that's offsetting. What if the equipment Shu purchased had cost $1,025,000? What would the total expense deduction be if 179 were elected? So it's only going to be the limit of 1 million, and then we would calculate depreciation expense the same way on the remaining 25,000, which would come out to 3,573. However, there is a second type of depreciation expense called bonus depreciation, which we're going to talk about next. So 100% bonus is for assets less than 20-year lives, fully deductible, no limits other than for luxury automobiles, which means that they cost more than a threshold amount. lessens importance of Section 179 because every asset can choose bonus. And 100% bonus is just the full asset. So there's no longer any, yes, it's interesting. This was all part of the 2017 Tax Act and Jobs. Now, we've had these types of deductions, but they worked a little bit more strategically. Listed, like in this case, they're like overlapping drastically. Listed properly, assets that have both a business and personal use component to them, such as autos, boats, computers, video equipment, music equipment. Section 179 is not allowed on listed property, that's what these assets are called, unless they're used more than 50% for business. So they can't be used more than 50% for personal and take that type of depreciation, which would only be on the portion that's used for business. Straight line depreciation is required for listed property that's used less than 50% for business. Now, the luxury automobile limitations, autos less than $6,000, first year depreciation $18,000, second year $16,000, third year $9,600. So what they're saying is you follow the regular calculations, but this is the maximum amount allowed to be deducted in that year of depreciation. Assuming the 100% bonus is, if not, so they actually, the limit is $10,000 if a 100% bonus isn't used. If a 100% bonus is used, these are the amounts that essentially the limits are higher because of the bonus depreciation. SUVs greater than 6,000 pounds, Section 179 is limited to $25,000. The 100% bonus is not included in this limitation. Now, leased vehicles have what's called a lease inclusion amount, the amount included in income when a leased vehicle is over the luxury auto levels. And there's a Rev Proc, which 2018-25 for amounts of total business. So ordinary and necessary travel expenses are deductible. Transportation is the expense of getting from one workplace to another within the taxpayer's home area. If you have a home office as a self-employed person and you work from home, then any trip where you're driving to a business location is deductible. What's not deductible is commuting. So if you're driving from your home to your business location to start your business day, that's considered commuting. From your business location, if you drive somewhere for business, that's business related and deductible. So that's one type of travel deduction, but then the other type is travel away from home that requires a stay overnight. This has to be away from what's called your tax home, which is wherever you meet the criteria of having an established residency. You don't want to not have a residency. It doesn't mean you can deduct everything. If you don't have a tax home, then you're considered a transient and you can't deduct any travel expenses. So when you're traveling away from home, you can deduct essentially everything related to that: travel costs, visiting clients, customers, business meetings, taxis, getting home to a temporary workplace, transportation between the home office and a temporary work location is deductible. Like I said, if you have a home office, then it becomes deductible because you're leaving your place of business when you drive away. So automobile expenses, to take a deduction, there are two methods: the standard mileage rate method and the actual expense method. For either method, you must keep a mileage log. You must track how many business miles you have and your total miles used during the year. Under the standard mileage rate method, your work stops there. You take 54.5 cents, it changes every year, times your business miles, and you get a pretty decent deduction. This is honestly, I don't always recommend going with the easier calculation, but in this case, 1,000 times. However, there is the actual expense method, which means you have to track all of your costs for a vehicle. Sometimes people will think, oh, I charged some gas and I went to a client, so I'm going to deduct this gas on my business card. Totally not legal. If you want to deduct gas, you need to track all of your gas for the entire year, all of your repairs and maintenance, all of your fees, all of everything you do to the car. And then you take the portion of business. So your business miles divided by your total miles is a percentage, and you get to take that percentage of your actual expenses. Now, actual expenses can give a larger deduction, but require immense more record keeping. Travel costs for business travel. So if you have to stay overnight away from home, then you can deduct the travel trip, which would include travel, meals, lodging, and other expenses. Should not last for more than 1 year. Sometimes people say, well, what if you think it's going to be a year? The moment you find out that it's not a year is when it stops being deductible. Limitations exist if the trip is partially personal, or if there are lavish or extravagant expenditures. And there are tables, just like for the automobiles, for cruise ship limitations for business-related travel, and for, I think it's a golf trip, resort, lavish costs. If a trip is part personal, that's fine, but depending on whether it's domestic in the U.S. or outside the U.S., and how many days were business or personal, you may need to prorate your travel costs, such as your airfare to the location, based on your business days to your personal days. Or if your personal days are more than business days, it may not be deductible at all. Or if it's international, it's prorated. Okay, meals. So this is a huge one. Business meal costs are deductible to 50% limitation, but they must be directly related or associated to business. And then, so essentially, if, you know, a business is paying for its staff members to have a meal while doing a training or something, it's at the benefit of the employer, that's still 50% deductible to the business. But meals as entertainment used to be a way to take a client out to dinner, a prospective client, and it was a more lenient requirement, and they did away with that deduction. Per diem has to do with what a business can deduct, and for simplicity purposes can reimburse employees for those amounts of meals. They're called the GSA per diem amounts, which you can find if you search that. Cannot be extravagant or lavish. A taxpayer can deduct $51 a day for meals and incidentals without keeping receipts on a business trip, subject to the 50% limitation. True. Taking 5 clients to a Major League Baseball game immediately following a substantial business discussion is deductible up to 50% of costs. Used to be, not anymore. A taxpayer can take depreciation on a business auto and use the standard mileage rate in the same year. It's either or. Depreciation on the vehicle is part of the actual expenses. So you get to use the actual method or the standard mileage rate method. Transportation costs are allowed only when the taxpayer visits a client. No. A deduction is allowed for meals, lodging, and other incidentals expenses when a taxpayer travels away from home and is required to sleep. Business use of home and business bad debts. So this is called the home office, and an area is deductible if it's used exclusively and regularly for the taxpayer's trade or business. This means that it can't be used to scroll the internet for personal purposes, which is how the home office got a bad rep for a while, because the IRS was pursuing people because they couldn't prove that it was used exclusively, and obviously in most cases it's not. However, then in courts, they shifted the burden of proof, which meant that the IRS had to prove that the taxpayer didn't use it exclusively, not the taxpayer having to prove that they did use it exclusively. And so that shift in burden of proof means that people can take a reasonable home office. It's not, often people ask if it's an audit trigger or it's not. A specific area of the home must be used only for business. For employees, they can do a home office, but only for the convenience of the employer. And I don't know why they have that here, because they got rid of the unreimbursed employee business expenses anyways, which was an itemized deduction, and very rare that an employee could actually get a deduction from it because of the extensive calculation. Home office deductions are reported on Form 8829, and then the home office amount would flow up to the Schedule C with the other expenses, decreasing self-employment net income, and then the net amount flows to your 1040 for taxes. A calculation determined by square footage used regularly and exclusively for business. So much like for the vehicle, we had standard mileage rate method or the actual expense method. Same thing for the home office deduction. You can do a calculation based on the square footage and just get $5 per square foot. However, it's a very small way of doing the deduction. Typically, actual expenses are more. Now, direct business expenses are 100% deductible. That means the area of your home office, any costs directly related to your home office are 100% deductible, such as if you painted the area. Indirect expenses have to do with the whole house, and they're allocated based on the square footage of your home office over the entire square footage of the house, and that would include most of your expenses like a mortgage or rent and utilities. So the home office deduction is limited to business income. So you can't make a loss based on the home office because it's a personal expense. So this is an ordering of deductions. Expenses that are deductible in any event, which mortgage interest and real estate taxes, those are part of the itemized deductions. So you have to deduct the deductions that you could deduct anyways first, even though it's substantially harder to take the itemized deductions now. Then business use of insurance, utilities, and depreciation. Business bad debts. Business bad debts really only come into play if the business used accrual method, right? Otherwise, the business hasn't reported it as sales, so there's no need to issue any bad debts. Now, if the business realizes that a customer isn't going to pay their accounts receivable, that's a bad debt, and so they might need to declare it worthless or completely worthless if they know that the business isn't going to pay them. Now, business casualty losses receive an ordinary loss. And in Chapter 7, you'll be learning about ordinary versus Section 1231 versus capital types of gains and losses. Not limited by 10% AGI floor like personal casualty loss. A business loss instead is ordinary. And again, we'll learn more about this next time. Jose uses 20% of his house exclusively for business. He had the entire exterior of the house painted and the interior of one room that he uses for an office painted for $3,000 and $5,000 respectively. What is the total deduction Jose can take as a home office expense for painting the home? So the $3,000 is for the entire home. So he's going to have to, he only uses 20% of his house exclusively for business. So he's only going to deduct 20% of the $3,000, which would be $600. And then the $500 is my exact example, just for the room. That's a direct expense, so it's fully deductible. So $600 plus the $500 is going to be D. Which of the following comments is true regarding the home office deduction? Taxpayer must see clients at home to be allowed a deduction, a home office deduction. No. The home office deduction is limited to income from Schedule C business. Yes. Taxpayer itself taxpayer is allowed to take Section 179 on the business portion of the home itself. No. Depreciation on the home is never allowed as a home office deduction. B was correct. When a business property is partially destroyed by casualty, the loss is calculated using which of the following? The decrease in fair market value of the property, the adjusted basis of the property, the lower of the decrease in fair market value, or the adjusted basis of the property. The adjusted basis of the property, less 10% of AGI. So when a business property is partially destroyed by casualty, the loss is calculated by which of the following? It's the decrease in fair market value of the property. Oh, sorry, the lower of the decrease in fair market value of the property, or the adjusted basis of the property directly before the casualty. The lesser of the decrease in fair market value, which is what society is willing to pay for it before the casualty and then after the casualty, whatever that amount that it dropped was, the lesser of that amount or the adjusted basis in the property. All right, hobby losses. So these were eliminated for 2018, but the income is still reportable. I think that's kind of unfair. Hobby losses were only deductible as an itemized deduction, so you still couldn't offset them directly, and you had to itemize to get any benefit. I think they should be allowed directly. Expenses are not allowed at all now. Education expenses, deductible if maintains or improves skills of the taxpayer or meets the express requirements of the law or regulation for a job. Educational expenses. These are not deductible if they cannot meet the minimum educational requirements for employment, or if the education qualifies the person for a new trade or business. So concept check here. If a taxpayer has shown a net profit for the last 3 years, that activity is not considered a hobby. True. Now that's debatable, but a taxpayer can never take a net loss on an activity considered a hobby. That would be best practice, true. Expenses that can be deducted elsewhere on the tax return must be the first expenses deducted from hobby income. That's true, that was that ordering of expenses. Educational expenses that help qualify a taxpayer for a new trade or business or profession are deductible. False. That's a reason that they're not deductible. Our final objective here, self-employment tax. Now, self-employment tax is also employment taxes. They're the same exact thing. There's employment taxes and self-employment taxes. They just have a different name. Also, as an employee, you pay half of this and the business pays the other half. When you're self-employed, you pay the full amounts, but you're going to get some deductions just like the business does for paying half of its employees' taxes. Social Security, 12.4, Medicare, 2.9. Total, 15.3. So as an employee, you'll notice in your paycheck, 7.65% is withheld. Social Security is limited, so it only applies, this 12.4%, to your first $128,400 of income. Then it doesn't apply anymore and it becomes a regressive tax rate, effectively. Medicare is not limited, so 2.9% applies on all net income. Kia had $43,000 of income from self-employment consulting practice and had no other income during the year. What is Kia's total self-employed tax? So we're going to take $43,000. We didn't meet the threshold, right? We're just going to times it by 15.3. So 43,000 times 0.153 is 6,579. Oh, I know why. So first, something we didn't just cover is we're going to take 43,000 And that's not what we calculate self-employment taxes on. Remember I said that because the business gets to deduct these taxes for 50% of them, the self-employed person gets a few advantages. So first we're going to take $43,000 and we're going to times it by 92.35%. That's going to bring us down to $39,710.50. And then we're going to times that by the 15.3%. And that's going to give us $6,000. Oh, minus 2 zeros there is $6,076. For the sake of time, our QBI deduction here is up to 20% of qualified business income. Okay, this was part of the December 2017 Tax Cuts and Jobs Act, which made a deduction based on income. This is unheard of, unprecedented, and the deduction is the lesser of 20% times your qualified business income, or it's essentially limited by 20% of taxable income. So it's essentially saying it's a check to limit it, which is without including your capital gains. If taxpayers are above the threshold, then so the threshold is $315,000 if you're married, $157,500, which is half of $315 if you're single. So if you're less than that, you can essentially take this. Accountants can't. There's a whole list of people who can't take it. But once you're above those thresholds, then practically no one can take it. It's quite interesting. It really appears to be for passive real estate investment businesses that employ people to run them for them, just in reading the law. Okay, guys, great job. I look forward to seeing you in the next video.